All right, welcome to an options deep dive video. And in this section, what we're going to do is we're going to take a look at making money with calendar spreads. Like, how does it actually work? And how do you set this up and how do you construct something? So as we go in, highly encourage you to check out kind of our options jumpstart course if you're brand new. Go to tradingwebinars.co and you can get these webinars absolutely free. So if you're brand new to options, calendar spreads, they're a little more advanced and tricky, so I'd be a little bit more careful. Let's go ahead and check this out with Zoom. We're going to go ahead and set up this calendar spread. When we go with Zoom, one of the reasons I might do a calendar spread here is we're looking at a possible move to the upside, and I could position a calendar spread a little bullish, bearish, or an at the money. So before we even get into this, we want to understand, like, how does a calendar spread make you money? Well, if you understand options time decay, right? So options theta or time decay, you might have seen something like this where 30 days out to 0 days out, your options continue to kind of decay, and it's like, oh no. So that's not usually a good thing, right? To decay. But what happens in a calendar spread is when we look at something like this, the 30-day decays slower than maybe something like a 15-day. So what we end up doing is selling the 15-day and we buy something longer dated to be able to offset that theta risk. And remember, the theta risk now is going to be in our favor. So we sell the 15, but we buy the 30 for protection. So if we go and look at, let's say this 39-day option, and we buy the 75, we'll analyze this trade. What you'll notice in this example is that right here, we're decaying about $6 a day. And that option cost me $455 or $4.55. So that may seem like a lot. So, and you know, for this to move, for the stock to move, I got to get the direction right or perfect. So unfortunately, I got time decay going against me, and it's got to move, and it's got to move in my favor for me to kind of profit from this. Now, what we can actually do is we can go to the, let's say the 25-day and go to the 75. And then what I'll do instead is sell this $262 option, which is also the 75 strike. And I'll analyze this trade. And now I bought something for $455 and I'm selling something for $262. So what that gives me is kind of a spread like this. You can see it's kind of like a little triangle. And you're actually able to now look at this theta. It's 0.15, so it kind of breaks even a little bit. Now I'm not doing it as a spread together, meaning, so in this case, because of that, it actually looks a little bit lower, like we're starting at a little bit of a down valuation, part of the bid-ask spread. If you actually do it together, you'll be better. But what we can do is also sell a little bit more of a, let's see, we're buying the August 25th. We could sell the August 18th and actually collect $315. So that's another one there that you could do. Or you could go to, let's say, August 4th. Okay, and this one now, you're buying something for $455, selling for $213, but your theta here is 1.45. Now, one thing you want to pay attention to is sometimes these things do get into earnings, and it does take a little bit of a trained eye to kind of spot these things when you see a volatility kind of pop. So you can see we go from 50 to 49 to 48, 52, 56, 55. So probably somewhere in there is earnings. So I might actually want to go a little bit into before the earnings right there. And now I've got a spread that's a little bit better. So what I've got is about a $2 theta per day. And we can even construct this here at 75 by, actually, let's go to the 18th, by a calendar. And now we'll do it as a together spread rather than individual. And I'll buy the August 18th, sell the August 4th, and there's kind of my difference is about $1.03, which is about similar over there between that difference. But what happens here is by buying that spread together, now it's a little bit tighter and closer to breaking even right from the start because you get a better deal or a package deal. So the way that this makes money now is that as long as your decay or your option hangs around that short one, you get to collect the premium, or that option decays faster. So with time, right here, as date moves forward, this white line, let me switch this to fixed. this white line right here gets closer and closer to expiration. So with time, that short dated option decays, and the long dated one still holds some of that value. And then you can get out of it earlier. Okay, so what you're really doing here is you're buying something longer dated and you're selling something against it. So it's very similar to covered calls, because you're buying something and you're selling something against it. So very, very similar to covered calls. But what you're doing here is on the option side. And if we go back and look into, let's say this August 4th, we sell the 75, and then we'll duplicate this. We'll switch it to a buy. We'll do the August 18th. What's going to happen is the one that you sell, if you look at what happens with the time, right here, this is the one we're selling. So the theta decay kicks in, and then what's going on is it gets closer to that expiration line. So you might collect 120 on this one, but the one that we bought, we might lose maybe $80. So we collected 120, but we lose 80. So you make 120, but you lose 80. So in total, what's happening is that the difference between that is what creates this calendar spread. So you're up, about 20 some bucks. So that's what's going on. So one of these is bearish and one of these is bullish. So the one that I'm selling here is bearish, so it creates this part. Okay, the one that's over here is bullish. So together, that's where, hey, one is bearish, one is bullish, and that's why this picture looks a little funny. So in either case, the way that we construct calendars, or we can construct calendars, is we've done it that way to break it apart. But you can actually do something very interesting with calendars into, instead of just doing kind of a single calendar and putting, let's say 10 of them right here. And if the stock slowly goes up, you make money from time decay and from slight appreciation. You could even position it more at the money, but you can even position these, instead of doing 10 in one spot, I could position 2 here, 2 here, 2 here, and even some at 70. Okay, and some at 75. And now you've got something like this. And you could position some at, let's see if it'll do it for me. 74 won't, but let's say 75. I could position some at 75. So you can keep working this depending on the amount of capital you've got, and you can start spreading your money, that even positioning some at 80, now you've got a couple of calendars here, more calendars here, and more here. So you're creating a bullish position. It's kind of like placing a lot of landmines in different zones and different spots. That allows you to kind of spread your risk, spread your capital, and you can really tweak it based on, hey, what are you trying to do? What are you trying to achieve? And now you've got these positions in different zones and different areas. So that's how a calendar really works and how it kind of makes you money. The minute you kind of get into a calendar, you're already looking, hey, well, once I get in, I could already take it off or position it for something, because you're buying something for 103. And I might go and pull the trigger on this, and we'll see if it gets filled quickly or not. Sometimes they don't get filled as quick. There we go. This one got filled pretty quick. And then what you can say is, well, let's say it goes and it takes a few days for it to move. I'd be profitable about 35 bucks. So if it goes up, I'd be profitable about 35 bucks. I could already create a closing order and try to sell it for about 32, 34 bucks or so. And that would mean, hey, $1.19. I've purchased that one for $1.02. So if I sell one for $1.19, that should give me about a $34 profit. And I could double click this, edit the order, put in a GTC order, and now send that in. And now let that order and position sit there for a little while. And if it gets hit, great. And then I'd be out. I don't have to watch or manage that trade. If it doesn't get hit, well, then maybe I'll need to manage it and do something a little bit different. But otherwise, that's kind of the basics behind a calendar spread, how it works. Obviously, we could go into it even further and deeper, but I think as an introduction, this is not a bad starting point for setting up and constructing a calendar. If you were to do it individually, and we'll just do something on, let's say, JP Morgan, I can go and buy something. Here's 25 days out. I'll do the 160. We'll just buy a single option right here. We can buy the 160 first. So start with that way. Unfortunately, oftentimes you kind of get ripped off if you do it individually, but there's my single option right there. I've bought something, I've got a single right there. And then what I can do is sell something against it. And that could mean, hey, I'll go to the 11 days and do the 160 and sell this one for 22 cents. So I paid 78 for the long duration. I'm getting maybe 22 back. Maybe I'll only get 15 back. Who knows? But then I'll send that one in, and then I'll have both of these cooking and working together. And there we go. Now, if the price moves up a little bit in my favor, okay, if it moves up in my favor, I'm positioning this like a little landmine. If it moves up in my favor, now I'm able to profit a bit from this position because the maximum value of it is at that corner, because that corner is there, but I'm getting $23 out of this. Okay, but the maximum is right there at that corner. That's where I'll make a little bit more between the difference of these two is kind of right there. So anyways, that's what we've got in this video. Hope that helps. I highly encourage you to check out the Jumpstart course if you're brand new to trading options. Go ahead, check it out, tradingwebinars.co. You can also check out our other website, criticalcharts.com or tradersfly.com. There's a lot of good free training material on both of those websites. And that way you can continue to learn and expand your knowledge further. Anyways, thanks again. Truly appreciate you sticking with me, and I will see you in the next video. Take care. Bye-bye.